One of the biggest debates in personal finance is, should you invest your money in the stock market or should you invest your money in property? Some people swear by buy-to-let property, whereas others say just buy an index fund and forget about it. So in this video, we're going to break it down in a simple way. We'll compare property investing, stock market index funds, real historic returns, the risks and advantages of each. We'll also look at a simple example. If you had £100,000 invested in property or £100,000 invested in an index fund, which one historically would have made you the most money? But before we start, here's a quick disclaimer. So this is not financial advice. I'm simply sharing historic data and explaining how these investments work. Past performance does not guarantee future results, and all investments carry risk. Always do your own research or speak to a financial professional before making investment decisions. So, what is stock market investing? One of the most common ways people invest is through index funds. And an index fund simply tracks a group of companies. One of the most famous examples of an index fund is the S&P 500, and that tracks the 500 largest publicly traded companies in the United States. When you buy an index fund that tracks the S&P 500, you are essentially buying a small piece of companies such as Apple, Microsoft, Amazon, and Google. Over long periods of time, the stock market has historically provided strong returns. Since the 1950s, the S&P 500 has averaged roughly 10% per year, including dividends. And after adjusting that for inflation, the real return is more like 7 to 8%. That's why many long-term investors choose index funds. They are simple, they are diversified, and historically, they have grown wealth over time. So now that we talked about stock market investing, we'll talk about what is buy-to-let property before we compare. So let's take a look at property investing. With a buy-to-let property, you genuinely make money in two different ways. The first way is rental income, and the second is property price growth over time. Across the UK, average rental yields are often somewhere between 5% to 7%, depending on the location, although some areas can produce higher returns. So let's use a simple example. If you bought a property worth £100,000 and it produced 6% rental yield, that would be roughly £6,000 per year in rent before your costs. Of course, that doesn't mean you keep the full £6,000. As a landlord, you still have to pay for things such as maintenance, insurance, letting agent fees, and mortgage interest. So the actual profit would usually be lower once these costs are taken into account. But property also has something that most stock market investing doesn't, and that is leverage. And that brings us onto the power of leverage. When you invest in the stock market, you normally invest your own money. But with a property, you can use a mortgage. For example, if you had £100,000 in cash, you'd be able to buy a £400,000 house with a 25% deposit. That means you control a much larger asset. So if the property prices rise by 5%, that 5% increase is based on the full value of the property, not just your deposit. This is one of the main reasons many property investors build wealth through buy-to-let. But leverage also increases risk. If property prices fall or rents drop, you still have your monthly mortgage payments to pay. So next, let's talk about historical stock market returns. Let's have a look at the historical numbers. So the S&P 500 has produced roughly about 11 to 12% average annual returns over the past 10 years, about 9 to 10% over the past 20 to 30 years, and roughly 10% annually since about the 1950s. When inflation is accounted for, real returns have averaged closer to 7 to 8%. This is why many financial planners use a 7% annual growth as a long-term assumption, but the stock market is volatile. Some years it rises 20%, some years it falls 30%. For example, during the financial crisis in 2008, the S&P 500 fell by about 37% in a single year. So investing in stocks requires patience and long-term thinking. Whereas property returns are harder to calculate because they depend heavily on the location, the leverage, the rental income, and the maintenance costs. But historically in the UK, house prices have grown around 3 to 5% per year long term, depending on the time period and region. When rental income is added, total returns can often reach something to 6 to 8% annually before leverage. And when leverage is used, returns can sometimes be higher. But property also has additional costs, such as stamp duty, maintenance, void periods, tax. So it's not as passive as most people think. So let's look at a simplified example that compares directly property versus the stock market. So imagine if somebody had £100,000 to invest. Option one could be the stock market. If you invested that £100,000 into an index fund that grew by about 7% per year, after 30 years, it would grow to approximately £761,000. Whereas if you put £100,000 towards a property deposit, you could buy a house that's worth £400,000. So you're controlling a much larger asset, but investing the same amount of money as you would in the stock market. So if that property increased in value by 4% per year, after 30 years, it would be worth £1.29 million. So in that scenario, the property investment ends up being worth significantly more. So what are the key differences between property investing and stock market investing? So stock market investing is very passive. It's very easy to diversify. There's very low transaction costs, and historically, you have had strong returns. Whereas with property investing, it is different because you have the ability to use leverage. You've got rental income every single month. You've got more control over the asset, but you've got a lot more work and management. So they're actually two very different investment styles. There are some risks involved in both stocks and property. For example, you've got stock market crashes, or you've got a lot of volatility, and a lot of people make emotional investing mistakes when investing in the stock market. But with property, there are also risks, such as the tenants not paying rent on time, expensive repairs, government regulation changes, and interest rate increases. So both investments, they do carry some kind of risk, and neither guarantees success. So which investment style is better? Well, the honest answer is it depends. Some investors prefer property because they like leverage, control, and a tangible asset, whereas other investors prefer index funds because they are simple, diversified, and very passive. In reality, many investors choose both. They build wealth through property while also investing in the stock market. So, if you had £100,000 to invest, would property outperform stocks? Historically, both have produced strong long-term returns. Stocks have been incredibly powerful due to compounding, and property has been powerful because of leverage. But the best investment often depends on your risk tolerance, your personal income, your time commitment, and your long-term goals. If you're interested in property investing, I'll be documenting my own journey building a buy-to-let portfolio. And if you're interested in investing in general, make sure to subscribe because I'll be breaking down more real numbers in future videos.